Here's what I'm going to do. I'm going to give you my investment strategy,
Okay.
and I'm going to be as honest as I can be,
Sure.
and you assess it based on your expertise and tell me if
Let's
I'm
hear it.
right or wrong. Okay, so I'll get down to my rec room, big screen TV, with my dab pen and my laptop, and I'll turn on Jim Cramer on CNBC. And when he tells me to buy, I buy, and if he says sell, I sell.
Yeah. You're getting financially whipsawed. So I think I called...
Is that working for me?
No, it's not going to work. So I kind of buried Cramer in the book. I guess I'm not going on CNBC anytime soon for any interviews.
Why would you bury Jim Cramer? I mean, this is a guy with an uninterrupted string of correct calls. Buy...
J.P. Morgan of this generation. Sam Bankman-Fried's FTX.
Listen, the best thing was an interrupted string of terrible calls. But listen, he's had a lot of good calls because he's on both sides of the market. He tells you to buy one thing on Monday and sell it on Wednesday and back, and vice versa. This guy literally is telling you. They actually did a study on this where they put up his recommendations of what he said on Monday and then on Friday. The exact opposite. Like one day he's saying the market's going up, next day it's going down. Buy this, go from this sector to that sector. That's historically, mathematically, scientifically proven to be the worst possible way to invest your money. They've gone back 100 years, the academic studies, and the analysts can't pick the right stocks. The hedge fund managers and the mutual fund managers can't beat the S&P 500, which is the overall broader market. And there's a reason for that, because all the information is out there. So unless you have inside information, which is illegal, right? And certainly the average person is not going to have that, or some other way to beat the market, whether it's high frequency trading with computers that are lightning fast. So some of the big firms, they'll time the market like a millionth of a second better than an average investor. They get an edge. But for everyone else, you can't beat the market. It doesn't work, especially when you deduct all the fees, the commissions, and also the taxes from short-term trading. So let's say a hedge fund returns 15% 1 year. Say, well, that's pretty good, right? But after they take their 2% management fee, 20% performance bonus, right? Suddenly it's not even beating the S&P 500, and that's in a good year. Most of the time they don't even beat it without their fees.
So why would anyone hand money to a hedge fund?
So Warren Buffett asked this exact question back in 2007. Made a big announcement. Bet $1 million. That I don't care whatever hedge fund you are, you can't beat the S&P 500 over 10 years. And at first, no one took the bet. Eventually, someone did with what's called a fund of funds. It was 100 different funds, right? And after year 7, they threw in the towel. They couldn't even come close to the S&P. And that was without all their fees. And just so you know, the fees they take, so it's 20% typically is their performance bonus, right?
Right.
If the fund makes money.
Off the upside.
On the upside. But if the fund loses money the following year, they don't get any of the losses. So it's heads they win, tails you lose, right? The mutual fund industry is equally bad. So they're engaging in, basically asset gathering, because what they do is they try to gather as many assets as possible, money, right? Because they get their management fees. But the returns on the average mutual fund are dismal. They don't keep up with the S&P 500, which is America's 500 biggest, baddest, most profitable companies. So, and those 500 companies change. So the S&P this year is not the same as it was last year. So what happens when you buy that index as the centerpiece of your investments, right, and just hold it, you're always having the 500 top high-performing companies in your portfolio. Is very tax efficient. Now, it's boring, but it compounds at about 11% a year. And guess what? If you invest $10,000, right, and just compounds at 11% a year, and you put a little extra money in whenever you can each month or each quarter, right? Over 30 years, 40 years, it turns into millions of dollars.
But I'm still caught up on the hedge fund idea. So Steve Cohen, Ray Dalio,
right?
All these guys are billionaires,
right? So you have
world's biggest art collection. So how did they get so rich if it doesn't work?
Well, for a time, it was like everyone thought, oh my God, they're so great, the hedge fund. So for many in the 90s and 2000s, like the word was really like this mystique that you had these really high performing hedge funds, and there were a few. There were a few people that actually can beat the market. Ray Dalio is one who's done it consistently. He's not taking your money. The average, when they're really that good, they don't take an average investor's money. They train their own money in a few very, very large institutions. So those funds are not open to the average investor. But then all the other hedge funds, which kind of suck, right? They're bathing in the afterglow of the aura of the hedge fund manager we see like on Billions, right? So you're this like mystical hedge fund manager. Well, guess what? Most of these guys suck. All right, they're not beating the S&P. They're just not. It's historically proven. They don't beat the S&P, and they take these massive fees when they do win 1 year, and they always get that 2% management fee. So watch what happens. Let's say you're managing $1 billion. So before you even start, it's 20 million a year you're getting just before the fund even starts, plus 20% of all the profits. And when you take those, and how about this? I'll go one step further. And also, when you have a hedge fund, you have to show activity. Because unless you can't just buy the S&P and hold it, because someone will say, well, why would I give you my money? You're not doing anything. So they almost have to show activity to justify their existence, which makes them engage in short-term trading. And human beings are just terrible market timers. And this is just it's proven over 100 plus years of studies that you cannot trade in and out of the stock market, buying, selling, buying this sector one day. So it's just a trap. The way I look at it is this. So Wall Street creates massive value. They do. Wall Street's necessary. You can hate Wall Street, despise them for what things they do wrong, but Wall Street is necessary. They create massive value for the economy. They take companies public, right? They finance the growth of America. It's needed. They maintain the debt markets, the credit markets. That's the useful side of Wall Street, where they create massive value. Then there's the not so useful, the dark side of Wall Street, where they create bubble after bubble after bubble, where they have instruments of financial mass destruction they create for just gambling purposes, where they churn you, they have excess commissions and fees, and rob the public blind. So the question in the book was, how does the average person get the maximum exposure to the good side of Wall Street, which is the great companies they take public and finance that become huge multinationals? So how do you maximize that, but avoid the corruption? Well, the churning and the burning and the financial bubbles and so forth, try to and play into what I call the Wall Street theme machine complex, which is this advertising monolith where basically they convince you, like people like Cramer, to play the sucker's game. But actively, if you go on CNBC, they're all day long trying to convince people to play the short-term trading game, which is indeed a sucker's game. So you go into a casino, right? We spoke about Kerry Packer, right? Gambling, right? So they own casinos, the Packer family, right? So in a casino, you go in there knowing that the odds are against you by 5%, depending on what game you play. So the odds are against you and the house will win over time, right? That's a legit casino. The odds are against you. But what if you go into a corrupt casino where they have loaded dice and are dealing from the bottom of the deck? That's Wall Street. So now not only are the odds against you because it's hard to pick winning stocks, but there's people who have information that's more timely than you. They're trading ahead of you. They are charging excess fees, and also you have all these publications and news, whether it's CNBC, Bloomberg isn't as bad, right? Because they cater mostly to professionals, but still trying to convince people that you could somehow figure out when you should buy oil and then sell your Meta and then somehow go into a steel stock and then go into overseas. It's insane. It doesn't work, and people get financially whipsawed. And I saw it myself, my own family member. Very successful guy. I start my book off telling his story.
About your brother-in-law.
Yeah, my brother-in-law. He's a very smart guy, and I watched his portfolio get decimated through short-term trading and using margin, all the things that they...
Was he doing it himself?
He was trying to do it himself and, following tips he heard on TV or online, and it's so simple.
And what happened to him?
Well, thankfully he's successful. He lost a lot of money, and then he learned his lesson, and I showed him what to do the right way, and now he's building a proper portfolio for the long term. So I think the distinction is this. You can get rich in the stock market, but not overnight. It doesn't work. You can't do that. And if you try to get rich by engaging in short-term trading or picking like one stock, you're probably going to end up in the financial poorhouse. So the solution I put in this book, which is ironic where I came from, right? Because I committed fraud 30 years ago, right?
Yeah.
So as you said, I've seen both sides, right? So the solution in the book is really very simple to build a world-class portfolio and secure your future. Because I don't think you can rely on Social Security these days. You'll have to pay for your diapers when you're in a nursing home by the time you get it, right? So this is about, empowering yourself financially, and it's about doing less versus more, not hiring experts.